Imagine waking up one morning, checking your phone like you always do, and for a split second, everything feels normal. Then you see the markets. Stocks are frozen. Prices aren't moving. Trades aren't clearing. News anchors look confused, not dramatic, but genuinely shaken. And quietly, almost invisibly, something far bigger than a normal crash has begun. This isn't a panic yet. This is something worse. This is a liquidity freeze. And once you understand what that really means, you'll realize why this moment could send silver not to $50, not to $100, but potentially toward $500 an ounce. Most people think market crashes happen because of fear, but the most dangerous crashes don't start with fear. They start with silence. No buyers, no sellers, no liquidity. When money stops moving, the system starts breaking piece by piece behind the scenes. And that's exactly what's forming right now. Here on Bullion Alert HQ, we don't chase hype. We track pressure. We track stress. And what we're seeing under the surface should concern anyone who holds stocks, pensions, or even cash sitting comfortably in a bank account. Before we go deeper, take a second to like this video and subscribe to Bullion Alert HQ. It helps this channel reach more people who want real financial awareness instead of surface-level headlines. If you value clear, calm explanations in times of financial uncertainty, you're in the right place. Now let's talk about liquidity, because most people hear that word but don't truly understand it. Liquidity simply means the ability to turn an asset into cash quickly without crashing its price. When markets are liquid, buyers and sellers flow freely. When liquidity disappears, even valuable assets can't be sold without massive losses. Think of it like oxygen. You don't notice it when it's there. But when it starts running out, panic comes fast. Right now, liquidity is being drained from the system in multiple ways at the same time. Central banks are tightening. Interest rates are higher for longer. Banks are quietly reducing lending. Hedge funds are more leveraged than they appear. And beneath all of that, trust between institutions is thinning. When trust weakens, liquidity dries up. Institutions stop taking risk. They stop making markets. And suddenly, prices stop making sense. Stock markets don't crash the way movies show it. They don't always fall in one dramatic day. Sometimes they simply stop functioning. Orders don't fill. Bid-ask spreads explode. Volatility spikes not because of selling, but because of absence. And when that happens, forced selling begins. Margin calls hit. Funds liquidate whatever they can, not what they want to. And that's when the real damage begins. Here's where silver enters the story in a way most investors aren't prepared for. Silver is not just an investment metal. It's an industrial metal, a monetary metal, and a physical asset with a supply chain that is already under stress. Unlike stocks or paper assets, silver doesn't rely on counterparties. It doesn't need trust to exist. It simply exists. During a liquidity freeze, paper assets suffer first. Stocks, bonds, derivatives, ETFs, anything that depends on continuous market function becomes vulnerable. But physical assets behave differently, especially ones that are already undervalued relative to money supply, debt levels, and real inflation. Silver today is priced as if nothing is wrong, as if debt doesn't matter, as if deficits don't matter, as if global instability is temporary. But history shows us that when liquidity disappears, price suppression mechanisms fail. Paper silver markets rely on leverage and confidence. When confidence breaks, physical demand takes over. Think about this carefully. The silver market is tiny compared to global capital flows. It wouldn't take much capital rotation for silver prices to move violently higher. And during a liquidity crisis, investors don't move slowly. They move suddenly. They rush toward safety, tangibility, and assets without counterparty risk. Many people ask, $500 silver sounds insane. And under normal conditions, it would be. But these aren't normal conditions. Price is not about fairness. It's about urgency. When trust in financial plumbing fails, prices reprice not gradually but instantly. Look at what's already happening quietly. Premiums on physical silver remain elevated. Inventory levels are tight. Industrial demand keeps growing. Green energy, solar panels, electric vehicles, defense technologies, all rely on silver. And at the same time, mining supply isn't expanding fast enough to meet future demand. This creates a pressure cooker effect. Now add a liquidity freeze to that environment. Funds that once shorted silver through paper contracts suddenly need cash elsewhere. They unwind positions, physical buyers step in, refiners struggle to meet demand, dealers raise premiums, and suddenly the spot price becomes almost irrelevant compared to real-world availability. This is how price disconnects happen. Not slowly, all at once. Stock investors often underestimate how fragile the modern financial system really is. Everything is optimized for efficiency, not resilience. High-frequency trading, just-in-time liquidity, massive leverage. These systems work beautifully until they don't, and when they fail hard. A liquidity freeze doesn't announce itself with sirens. It shows up as small anomalies, a bond auction with weak demand, a bank quietly needing emergency funding, a trading halt that lasts longer than expected. These are cracks, and cracks spread. Central banks can inject liquidity, but only to a point. When inflation is already elevated, their options become limited. Print too much, and currency confidence erodes. Tighten too much, and markets seize up. This is the trap, and we are deep inside it. Silver thrives in this environment because it sits at the intersection of fear and necessity. Investors want it for protection. Industries need it to function. That dual demand is powerful, and when supply can't respond quickly, price becomes the release valve. This is why Bullion Alert HQ has been emphasizing physical metals, while most channels are still debating soft landings. Because soft landings don't happen when liquidity freezes. They happen when systems are healthy, and right now the system is stressed. Ask yourself this. If markets froze tomorrow, would you rather hold digital claims on assets, or something tangible that exists outside the system? That question alone explains why silver behaves the way it does in crises. As we move closer to the end of this video, I want you to think long-term, not emotionally. This isn't about fear, it's about preparation. Liquidity freezes don't give second chances. They punish complacency and reward foresight. If you've stayed with me this far, comment below and let me know where you think silver is headed if markets seize up. Do you think most investors are prepared for a true liquidity crisis? Or are they still relying on the same assumptions that worked in the past? Your thoughts matter, and this community learns from each other. And if you found this breakdown valuable, share this video with someone who still believes markets always bounce back quickly. Awareness spreads faster than panic, and that matters. Here on Bullion Alert HQ, our goal isn't to scare you, it's to help you see clearly before the headlines catch up. The liquidity freeze isn't a theory, it's a process. And once it fully locks in, the repricing will be fast, unforgiving, and historic. Stay informed, stay grounded, and stay alert.